So we're still on Chapter 7, and now we're going to value accounts receivable. What does that mean? Well, here we have recorded our accounts receivable. We've recognized it. It's on the books. And this assumes that, we're going to collect, cash on that eventually. And so accounts receivable is an asset. It shows as 1,000. But when we talk about valuing it, we have to really what we're trying to portray is the economic reality of what's going on. Now, is the economic reality that we're going to collect all of our accounts receivable? Probably not. There's always going to be some customers who do not pay. And so to properly value our asset accounts receivable, we've got to make some allowance for that. So we're going to look at what's called the allowance method of dealing with bad debts, and we'll also look at the direct write-off method. Okay, we'll start with the direct write-off method. So say this person doesn't pay us. We find out they've gone bankrupt, they're not going to pay it, we're not going to see that receivable. So under the direct write-off method, we would simply write it off. If we found out at the end of the month that this customer had gone bankrupt, there's no chance we'd ever collect it, we would simply go bad debt expense, and we would write off that particular account receivable for the $1,000, okay? We're not going to see it, just write it off. Okay, this method is not generally accepted accounting principles, it's not GAAP. It's okay to use if bad debts are a minuscule part of your business, if they're not a major part of your overall receivables. And so this is the method that I could use in my construction company because we had so few write-offs like that. I think over the course of 16 years we maybe wrote off $400 because all of our transactions were under purchase and sale agreements, or they were all under construction contracts, and so bad debt expense just did not play a big part in our business. And so we could use this method, and it was okay. Most companies, it's not okay, okay, because if you think of a retail operation, bad debts are, a larger percentage of what they've got going on, of their receivables. So the method that is approved under generally accepted accounting principles is the allowance method. Okay, so the allowance method, we're going to take this same receivable and we're going to say, okay, so based on past experience, we've got $1,000 in accounts receivable, and based on past experience, we're going to collect most of these, but maybe 200 won't get collected. So what we're going to do when we book these receivables is we're going to make a journal entry. We're going to debit bad debt expense as we did before, but we are not going to credit any accounts receivable because, and this sounds a little weird, but nobody has not paid us yet, okay? So we can't write off any particular account receivable because we don't know who's not going to pay. So what we do instead is we create the allowance for doubtful. This is okay. This is why I work better on Excel than on whiteboards, but allowance for doubtful accounts, which we can abbreviate on exams for allowance for doubtful accounts, okay? Allowance, DA, I'll know what you mean. Okay, so bad debt expense, allowance for doubtful accounts, and I think I've got to sort of abbreviate that now or I can't really make the journal entry, so allowance for doubtful accounts, and I'm just going to say it'll be 200. Okay, so now we've set up this allowance account, and so on the balance sheet, what you would have is accounts receivable. Okay, so you've got accounts receivable. You'd have accounts receivable of the 1,000, and then you'd go less the allowance for doubtful accounts of 200, and that would give you accounts receivable reported on the balance sheet of the net realizable value, which all that means is this is the amount you actually expect to collect based on past experience. So now, on the balance sheet, under the asset section, you're showing an asset of 800 rather than 1,000, which more properly reflects the economic reality of how much you're going to collect. Okay, so I think so that's okay. So let's see how this allowance method works. So we've done the first two parts. We made the sale. Based on past experience, we are estimating that 200 of those sales, or the 200 of those receivables, will not be collected, and we've set up an allowance for it. Okay, so now what happens when we have an actual write-off? So we find out that someone who owes us $50 is not going to pay. So say it's October 30th, and we have an actual write-off of $50. Okay? So no way, I can't pay. So what do? Well, here we're going to debit the allowance for doubtful accounts that we've set up. We figured 200 worth would not pay. Now we have an actual write-off of 50. And the logical credit entry is to that particular person's account receivable, because they're not going to pay us. Okay, so we have written off our, an actual write-off. Okay, so we get 150 left in our allowance account for other people who might not pay. But notice that we are not debiting bad debt expense. That happened when we made the initial, well, that happened relating to the initial receivables. We estimated the bad debt expense that went with them, and we set up the allowance. Now we're using up some of that allowance. Okay, so now what if this person unexpectedly sends us a check? Now we've written off that receivable. So if we get an unexpected payment, okay, so an unexpected payment, so say he got a big Christmas present from somebody, a big, and so says, oh, well, I really should pay that, pay what I owe there. First thing we'd have to do is to reinstate the account. So we would have to put the account receivable back on the books. So there's that going back on. We would put the $50 back in the allowance. Okay, so here's the allowance for doubtful accounts. So we've essentially reversed the entry to write it off. And now we can say, oh yeah, now we can record the cash that we received and reduce the accounts receivable for that person. Okay? So that's your basic allowance method. You make the sale. Based on the sale, you set up the allowance. Okay? When you have an actual write-off, this is where we get into the actual write-off situation, you're debiting the allowance and crediting the account receivable that's getting written off. And if that person ends up paying, eventually after they've been written off, then the first thing you have to do is to reinstate the account, put the account receivable back, put the allowance, the 50 back in the allowance account, and then you can record the cash. Otherwise, their account receivable would be zero, and you can't record a cash that you received cash on it. Okay, so that's your basic direct method that we looked at, which is not GAAP, but it's okay if you have an insignificant amount of write-offs. And then the allowance method, which you'll definitely need to know how that works. So the next thing we get to is, how do we actually make this estimate? And that will be our next topic.